The Daily Market Show. Here's your market update.
All right, guys, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with stocks at record highs again. Let's get right to the scorecard here with 60 to go in regulation. Dow is leading the way today, yet again following through on yesterday's post-Fed move. We are on track right now for record closes for both the Dow and the S&P. And once again, it's outside of tech where the story really is. The equal weight S&P and the Russell 2000 both hitting record highs of their own today. Banks having a very strong day, as are the insurance names. We're tracking all of that into the close today. Oracle, though, it's the stock story of the day for all the wrong reasons. It's sinking following its earnings release. That's one of the worst days in a while for that name, down 10%. And the AI trade's going to get another test in overtime today when Broadcom reports. We'll lead you up with a preview of exactly what to expect from that one. Other standouts today include Marriott and Hilton, Nike and Target, just a few of the bigger gainers today. Takes us to our talk of the tape, this record-setting rally and how far stocks can go. Let's ask Tom Lee. He is FundStrat's head of research, a CNBC contributor. He's with me at Post 9 because he is out with his 2026 outlook for stocks. Thanks for sharing it with us first. We appreciate you for that. So let's get right to it. So we're going to 7,700. That's the headline. So that's a pretty decent year in the year ahead. Not quite as robust as we had this year. Why that target?
Well, we're 3 years at 20% gains because the S&P probably closes 7,000 or so this year. And so I think there's a deceleration of what the market can do next year. But that 10%, I think, belies what will be a very turbulent year, similar to this year, where this year we had tariffs and sort of a Fed that became hawkish again. Next year is a year where we have a Supreme Court potentially overturning tariffs, and then a new Fed, which will be tested. So I think we could have what looks like a bear market in 2026, but we exit strong.
I mean, even with a new Fed, and it's divided, obviously, as we learned yet again yesterday. We know from what the president wants to do in terms of who he wants to appoint that the bias is going to be towards easing.
Correct.
So why so much turbulence around that particular issue?
You're right. I think next year the real message at the end of the year will be there's the Fed put back in play. So then you have a White House put and a Fed put, which are tailwinds for stocks. But before all that happens, the new chairman has to be confirmed. It takes about 90 days from the time that his nomination takes place and the confirmation. And the markets always test a new Fed chair. So I think that is the January to October period, is that the Fed is being tested, even though we know it's going to be a dovish Fed and a Fed put comes out of that.
We think we're going to get, at least if you believe the outlook, which that's, it's your own prerogative, a cut into a strengthening economy, though. At the end of the day, that supersedes everything. Isn't that partly what the last couple of days, yesterday and today, are about?
Yeah. This was in my mind, even though people positioned it as a hawkish cut, it's actually quite bullish for stocks because the Fed, again, is now weighing the downside risk to the economy, which is the Fed put coming back into play. Plus, as you know, QT ended, and even though it's not officially QE, it's the absence of tightening, which is QE.
You call it whatever you want. If the effects of whatever they're doing are nearly the same as if you want to call it QE, the bottom line is stocks went up and rates came down.
Yeah.
And if that continues to be the picture, it's going to be hard to lean against the equity market in that scenario.
Correct. And the right groups are responding, as you highlighted. Small caps hitting record highs, financials rallying. And now what we just want is the ISM to turn. But if housing can turn, then you've got a real broadening taking place next year.
See, when you still talk about a wall of worry, I feel like that's debatable now. I felt like it's debatable for the last few months, but once you get into the new year, do we really have a wall of worry? As I said, we expect the economy to strengthen. The Fed's going to have a dovish tilt. Even with a new person, you're going to have some of the impacts of the the big, beautiful bill. You're going to have what should be a better environment for M&A and even IPOs. We may get some of the largest we've ever seen from the AI space, not to mention the AI trade in and of itself. Is that really a wall of worry?
Well, those are definitely all tailwinds, Scott. But in our conversations with clients, we find skepticism about valuations.
Okay.
Fears of
Fair.
an AI bubble.
Fair.
The Supreme Court overturning tariffs does create turmoil at a time when the midterms are now in people's minds.
Would that be a plus for stocks?
Well, it is and it isn't, because now it makes policy uncertain again and the economic ripple effects uncertain, because if the tariffs stay in place, and remember, markets don't expect the tariffs to hold, then we can anniversary a lot of the effects. But if now we're talking about them being reversed, some companies suing to get refunds, and then new tariffs coming, it adds to the lack of visibility.
So on the issue of AI, how does the breakdown happen and what leads the market to your target of 7,700 and what lags?
Well, I think tech is going to be a group that probably has to digest the prodigious gains made this year into early next year. And we know that whenever tech starts to stall, people wonder, is that the leadership ending so the market will fall, or is this a rotation? And that's controversial.
Isn't that what's happening right now?
Yeah, and you can see sentiment has not improved in the face of that. People have turned bearish because of that.
They've turned bearish. I feel like this is confirmation of exactly what a bullish story would want to be. That you could have a step back in the tech trade, but man, if you get a pickup in equal weight and you get a pickup in the Russell and you get a pickup in all these other areas, that's what keeps the market from being upset by the lack of performance from tech.
That's a rational explanation. It makes perfect sense. But in our client conversations, people are more bearish now because tech is stalling. And it's in the backdrop of 75% of the weeks this year, sentiment on AI has been negative. It is only something you see in the middle of a bear market. So I think people are sort of entrenched in their bearishness, even as we exit strong, and I think that carries into next year.
Man, I mean, I don't know who you're talking to. I feel like it's hard to find people who are bearish, which is why we've got a couple people on the desk that we're going to bring into the conversation now and see where they stand. New Edge Wealth's Cameron Dawson, Invesco's Brian Levitt, both here at Post 9. You guys aren't bears. You're not bearish, are you?
It is really hard to fight a market that's in a clear uptrend, that has Fed support, that has fiscal policy support, where earnings estimates are still going up, GDP estimates are still going up, but this market is priced for perfection, and it's expecting perfection. You have a 22.5 times forward multiple. Earnings estimates look to be very fulsome, $309 a share. That includes 200 basis points of operating margin expansion. So it is definitely something you don't want to bet against the great American might of margin expansion. However, that's a pretty high bar. But to Tom's point, you are only in the 60th percentile in Institutional Investor Positioning Survey. So there is still room for people to get dragged kicking and screaming into this market.
Well, those are two different ideas. There is the idea, as Cameron says, of FOMO, of chase for performance. Mm-hmm. Then there's the realization of whether earnings are going to live up to the hype to justify the valuation that Cameron suggests that we are at and we may expand to.
Yeah, and I think we will. And you know, it's funny when you talk about hearing people's concerns. I mean, I think that's what I do for a living. I hear people's fears all the time, so it always sounds like they're somewhat pessimistic. But the backdrop continues to be quite good. You're in an environment where leading indicators are picking up a bit. The Fed wants to ease. Inflation expectations are contained. I mean, it's a good backdrop. And our outlook coming into the year at Invesco was about this broadening out. A lot of the concerns we hear is valuations concentration, and what's nice about an environment with easing and a pickup in economic activity is you can build better value portfolios, whether that's non-U.S., whether that's down capitalization, equal weight. You can build a better value portfolio and participate.
I mean, 6,900 right now. S&P's never been higher in terms of where it might close, and we're going to track that right to the end. It just shows you the optimism. You're bullish.
I'm bullish.
Right?
I'm bullish. And look, when do I get less bullish? If I have inflation expectations breaking out, if I have credit spreads,
they're not.
If I have the Fed having to become more hawkish,
and they're not.
If credit spreads are blowing out,
and they're not.
So this, to me, it's more about leadership. I'm very convinced that this cycle is continuing. The question that we've been debating is the direction of it. Are we gathering momentum here? And I believe we are. And as you gather momentum, you want a different type of risk in the portfolio rather than 2023, 2024, where global growth was kind of not doing anything.
All right. Well, let's stay on that theme and welcome in another guest. Jonathan Krinsky, BTIG, has a new note on the small caps today, so we wanted to bring him in to talk to you about it. It's nice to have you, especially given this move we've seen in the last few days, at least. We getting confirmation of a bigger breakout?
Hey, Scott. So, there's a couple of points here. One, we had the Russell 2000 breakout in September, 2 new all-time highs, but the S&P 600, which is a small cap index that has a profitability component, really continued to struggle even despite that breakout. So it was more of a speculative, lower quality breakout. And what we have the last couple of days is that S&P 600 actually joining the Russell 2 and is within, a very close margin of hitting its own all-time highs. And, when we think about small caps, we're basically at the same levels we were 4 years ago in November of 2021. So, if this breakout can hold, then, there could be meaningful upside to the small cap trade. And at the same time, we're noticing some moderation or relative weakness in some of the Mag 7. NVIDIA's been trading a little bit poorly. Meta is below its 200-day. So when you put all together and you look at the ratio of small caps to Mag 7, we're now really just starting to break out above a multi-year downtrend that started, back in 2022, 2023. So I do think there could be some runway, and it's definitely a theme we'll be watching as we head into 26.
So it's okay that there's relative underperformance from the Mag 7s. You're telling me there's runway despite that fact, as long as the other parts of the market that you're citing here continue to participate, all is well.
Well, yeah, I think there's a difference between relative underperformance and absolute weakness, right? And up to this point, I think it's really just the relative underperformance. I think the pullbacks in NVIDIA and Meta are, you could argue Meta is potentially changing the trends. It's probably one of the weakest of the Mag 7, where you actually have the price under the 200-day and the slope of the 200-day is potentially inflecting lower. So if you were to start to see more Mag 7 names have that setup happen, that would be a bigger concern for the market. As it stands now, I think it's a function, and kind of what Tom was saying is maybe you get just some lagging or underperformance from the S&P. Maybe it does grind a bit higher, but the alpha is going to be in small caps.
Okay, interesting. We saw your note. We needed to talk to you about it. Jonathan, thanks for making time for us. We appreciate you. Jonathan Krinsky, BTIG. Mr. Small Cap. We have a good year. We're up 16%, okay? And a lot of it's been done in the last, well, not a lot of it, but a good amount of it we have watched in recent trading sessions.
Yeah.
You want to make a big call about this again?
Well,
small caps in 2026?
I just don't want to jinx it, Scott. That's why I'm silently watching it, because every time I kind of feel confident about small caps, there's a bit of a rug pull. But it makes sense that small caps should outperform because the Fed's dovish, and the ISM, which has been below 50, is finally going to break out, and small caps valuations relative to large caps have never been cheaper. So
but you made the point already, though, that there's going to be this tension within the Fed complex because of a new chair. Will that also, if it leads to some sort of volatility or turbulence, as you use, won't that upset that trade?
Yeah, in the short term it will. I just think next year it's going to feel like a full cycle again. A rally in the beginning, turbulence, and maybe a bear market, 20% decline like we had this year, but then we exit really strong, and maybe a rally to end all rallies type at the end.
What do you think about that?